Well, it's certainly been a challenging situation over the last month, but what we still believe is that investors should be constructive on technology and constructive on the stock market more broadly. Because while we've had this little dip here in downdraft, which is not unexpected in the month of September, we think that as you get through the end of the year and into 2022, there'll be a lot more opportunities, and we'll start to see a continued lift as earnings continue to improve. And hopefully we'll get a little bit of positive news flow coming out of earnings season in the next couple of weeks.
You know, speaking with a trader on Wall Street the other day, and he basically said, you know what, Brian, we've given up. We used to have bears and we had bulls. Now we only have bulls and those that are reluctant bulls. He basically implied Wall Street has learned no matter what happens, you hold your nose as much as you hate it and you buy the dip because the upward market forces are stronger than the down market forces, even if we get a drop. Would you kind of agree with that sentiment, even if maybe the fundamentals or the valuations or whatever don't always make sense at the moment?
I think long term, the trend is your friend, to your point. And there's an old adage that I used to hear starting out in the business, which is bulls make money and bears make money, but hogs get slaughtered. And I think when you think about it from the bull side of the house, the earnings situation is still good. It may not be perfect, but it is good. And when you think of it versus, say, the bond market, and you think of where we are with yields, where we basically had a multi-decade bull market in bonds, it's really tough to get excited about the bond market right now. So when you look at risk assets, there is an actual opportunity there if you can wait and you can see earnings really lift into the valuations that we're currently holding. So we're still constructive on it, but we acknowledge that it's challenging with all the noise going on out there, particularly with what's happening in DC, what's happening with the Fed. There's no lack of negative news flow coming out.
Some big stories out there. You mentioned it. I mean, we'll see what if any of these spending bills get through. Oh, by the way, another property developer in China missing an interest payment. We'll get to more on that as well. Inflation, it may be here to stay a lot longer. So with all that in mind, Alan, you're saying sort of go long and strong, or at least stay steady. What parts of the market, what stocks, what groups, whatever, look best to you and your team?
So you nailed it. It's staying steady. It's not trying to hit the home run. We believe that you should still have an overweight to stocks. We think that that's really the opportunity set right now, particularly vis-a-vis bonds. But then when you start to narrow that lens, as you look within the market, we're still constructive on large cap equities, domestic equities. We feel that large cap stocks should have better opportunity sets than maybe their small cap brethren right now, particularly in light of some of the noise coming out both on an international basis, but also what's coming out of Washington. And then when you look a little bit within the sector rotation, we still think that cyclicals can do well. We've already seen it with the financials and the energy set, but we also think things like industrials can do well as we start to push through the Delta variant and we start to get to more of a normalized economic outlook as it relates to from the coming out of the pandemic.